Welcome to Bankless, where today we explore the frontier of investing in these uncertain times. I've got a solo episode for you today. It's just me. I'm here to help you become more bankless. In today's episode, we have Louis-Vincent Gave. He gives us 7 ideas for investing in these uncertain times. So Louis is a macro analyst. He's got some hot takes, I would say, some of which are contrarian, all of which are actionable, which are the best kind of macro takes if you ask me. And if you own assets, if you're an investor, and that's probably everyone that listens to Bankless, I think you're going to love this episode. Even if you don't agree with everything that Louis says, and maybe especially if you don't agree. A few things we talk about. First, we open things up with the recent market mayhem. The yen carry trade. You're probably familiar with everything that happened earlier in the month of August, all of these shenanigans. What does Louis think? Are we headed for a bear market? Then we get to his core ideas. These are the 7 ideas on how to invest in these times. I will list a few of them. These are my paraphrased words. Number 1, you got to avoid the bond market train wreck that's coming. Number 2, avoid duration at all costs. Number 3, 60-40 is dead. And he gives us what's replaced it. Number 4, U.S. equities, why they're expensive, and non-U.S. equities are cheap. Number 5, don't worry about the recession. Buy value. Number 6, Asia as king. And number 7, why the dollar will devalue and what that looks like. At the end, we also discuss our favorite subject, which of course is crypto. He's got some spicy takes on that too. So if all of this sounds interesting, strap in. We'll get to the conversation in just a minute. But first, got to mention our favorite place for buying crypto in these uncertain times. That is KRAKEN. If you don't have an account after all of this time, pause this podcast, go create an account, and get yourself set up with KRAKEN today.
If you want a crypto trading experience backed by world-class security and award-winning support teams, then head over to KRAKEN, one of the longest-standing and most secure crypto platforms in the world. KRAKEN is on a journey to build a more accessible, inclusive, and fair financial system, making it simple and secure for everyone, everywhere, to trade crypto. KRAKEN's intuitive trading tools are designed to grow with you, empowering you to make your first or your 100th trade in just a few clicks. And there's an award-winning client support team available 24/7 to help you along the way, along with a whole range of educational guides, articles, and videos. With products and features like KRAKEN Pro and KRAKEN NFT Marketplace and a seamless app to bring it all together, it's really the perfect place to get your complete crypto experience. So check out the simple, secure, and powerful way for everyone to trade crypto, whether you're a complete beginner or a seasoned pro. Go to kraken.com/bankless to see what crypto can be. Not investment advice. Crypto trading involves risk of loss. The UNISWAP extension is here. The self-custody wallet, created by the most trusted team in DeFi, UNISWAP Labs, designed to make swapping feel effortless. This extension lives in your browser's sidebar, letting you swap, sign transactions, and send or receive crypto without ever losing your place on the internet. Plus, with human-readable transaction messages, you'll always know exactly what you're signing. Navigate a multi-chain world effortlessly with support for 11 chains like Ethereum Mainnet, Base, ARBITRUM, and Optimism. No more chain switching or token importing. All your assets are right where you need them to be. The UNISWAP extension is designed to level up your swapping experience with other UNISWAP Labs products as well. Easily onboard to the extension using the UNISWAP mobile wallet to begin managing your assets across platforms and take advantage of smooth, seamless synergies with the UNISWAP web app. So go and download the UNISWAP extension today by clicking the link in the show notes. Just another way UNISWAP is helping you swap smarter. The OBOL collective is up and running and is maybe one of the most important collectives that you've never heard of. OBOL is bringing distributed validators, or DVs, to the Ethereum staking stack. Distributed validators allow multiple parties of people running multiple nodes to create a single virtual Ethereum validator together. This makes participating in Ethereum consensus more accessible, more affordable, and more inclusive. It is a strict improvement to the Ethereum staking tech stack, with collaboration from Lido, EtherFi, EigenLayer, and 50 other entities, and thousands of individuals. The OBOL collective is working to scale and decentralize Ethereum using DVs. And now you can get involved. Introducing the OBOL Contributions Program. Visit obol.org/bankless to stake on DVs, either through a partner staking protocol or at home. Earn access to future governance and ownership in OBOL while contributing to retroactive funding for projects that are actively decentralizing Ethereum. This is your opportunity to secure inclusion in one of the most important projects working to scale Ethereum's foundation for future growth. Visit obol.org/bankless to get started. That's obol.org/bankless.
Bankless Nation, I'm very excited to introduce you to the first time to Louis-Vincent Gave. He is a macro investor who co-founded GavCal Research. And I think David and I, when we have podcasts like these, we really enjoy macro investors who do 2 things. One, they have something to say, and secondly, they make sense. And Louis is definitely one of those. He also wrote a book a few years ago, which I haven't had the chance to read, but I enjoy the title. It's called Avoiding the Punch, Investing in Uncertain Times. And I think I want to steal that theme for today's episode, Louis. I think what we're trying to figure out is how to avoid the punch and invest well in these uncertain times on the episode today. So, Louis, welcome to Bankless.
Well, thanks a bunch for having me. It's a real pleasure to be here. Thanks for plugging my book. It's a bit dated now. To be honest, I wrote it at the time. The main thesis of the book, it was published back in 21. The thesis of the book was how'd you put in cushions in your portfolio in a world in which bonds are slated to get destroyed. And of course, you could argue that since then bonds have been destroyed. I think we're just at the beginning of the destruction of the overall bond markets. But that was the thesis of the book 3 years ago when it was published. I guess it'll be time will tell whether it's now outdated or just at the beginning of a new trend.
I mean, I think that's a killer theme, and I think, according to you, this is the beginning of a new trend. And we haven't changed from that subtitle, which is like investing in uncertain times. Maybe it always feels like this, but it feels like the 2020s, particularly when I talked to you on August 14th. 2024, these seem like very uncertain times. Let me just ask maybe that question. Do you think this time in the markets and investing is more uncertain than other decades that you've been a player in this game?
I'm 50 years old, and I've been through a few crises. I actually started my career more or less during the Asian crisis. I was working for a French investment bank, and they sent me out to Asia just at the time where Asia was imploded. And to be honest, back then you'd have currencies such as the Indonesian rupiah, the Malaysian ringgit, that would fall 5 or 10% a day. That felt like the whole world was collapsing. And of course, the 2008 crisis, it did feel like all of a sudden you were wondering whether you'd be able to get money out of the ATM come Monday morning. Again, I'm 50 years old, over 3 decades. I've had periods of deep uncertainty. I think the uncertainties today, what's fascinating is they're not even uncertainties. The biggest issue I think we're confronting is the fact that here we are, at the top of the economic cycle, record low unemployment, U.S. economy humming along at 6-7% nominal GDP growth rates. And the U.S. government is running budget deficits of 7% of GDP at the top of the cycle. This to me it's not an uncertainty because you can see it, you see the numbers. What is highly unusual, and by the way, this is true of Canada, and this is true of France, and this is true of the UK. What we're coming to, the big uncertainty is you're looking at welfare states everywhere. Welfare states that were essentially built as one big Ponzi scheme. It was always, as long as you had more people coming in at the bottom, more new workers coming in, and not so many old people, the welfare states worked. And the reality is the welfare states have stopped working, and financially they're now breaking down. And you're seeing this all across the Western world, and you're seeing the manifestations of this everywhere, where they've been failing public health systems or they've been failing educational systems. The welfare states are collapsing. Now, they're not going to collapse at the same time everywhere, and they're not going to collapse in the same fashions. But, when you look at a U.S. government that is slated to issue, on a good year, 2 trillion of additional bonds in debt, and on a bad year, 4 or 5 trillion, the numbers start to get really, really big. So, the odd thing is that it's not even uncertain. It's there. We see it. The maths are there. What's uncertain is how this will all play out.
Yeah, I think a lot of listeners to Bankless, regular listeners of Bankless, will have come to a similar kind of thesis as yours, that things are getting out of hand in Western welfare states in particular. It's, part of our crypto thesis in general, of course, which we'll get to. And I also want to get to kind of, what does this mean? So what are the conclusions? And Louis, I feel like you have a fantastic perspective on a few key conclusions. In fact, I saw this slide with 7 of those conclusions, and I want to go through them one by one and then maybe work our way back to how you came up with this conclusion. But actually, before we do this, since you brought up crisis in Asia, let's talk about what just happened on August, I believe it was the 4th. So this is a couple weeks back. So we've had some dust that has settled, and we had market mayhem, chaos. The VIX spiked to like 60. We saw in our world in crypto, I mean, price of Bitcoin was down on a Sunday 15%. Our markets trade 24/7. Price of Ether was down 25%. It felt like a shock. We had some macro investors on, Tom Lee from CNBC. He came in, he said, not to worry, this is just a growth scare. Others have said, look, this is more permanent. This is the beginning of a bear market. What's your take on why this happened now that some dust has settled and like where we're headed?
So my starting point is that there was and there are still three massive anomalies in the world that we live in. Three prices, that make absolutely no sense. The first is the Japanese yen. I think you have to travel to Japan to realize how the yen at 160 just doesn't make sense. Being able to go to Tokyo and have by far the best meal of your life for half the cost of a meal anywhere else, and of a mediocre meal anywhere else in the world, tells you that the yen is deeply, deeply mispriced. And the fact that there's so many tourists in Japan today is a testimony to this. So that was the first anomaly coming into the summer. I think there's a second anomaly coming into the summer, and that's the valuation of everything linked to big tech, to AI, to semiconductors. If you take the MSCI Semiconductor Index, it was trading at 9 times book coming into the summer. This is for a deeply cyclical, deeply capital-intensive industry. 9 times book is just crazy. Historically, semiconductors trade 2 to 6 times book, 6 at the top of the cycle, 2 at the bottom of the cycle, and here we are at 9. So you had this second massive anomaly. And I think in the world that we live in is a third anomaly. And the third anomaly is that China right now is running trade surpluses of 100 billion a month. And it's running trade surplus of 100 billion a month because in the past few years, China has massively leapfrogged Western industry on pretty much everything, on cars, on solar panels, on trains, turbines. I mean, you name it, China has grown leaps and bounds, and is now way more productive than anybody in the Western world. So with that, logically, the renminbi should have gone up. When you're running trade surplus of 100 billion a month, logically your currency should be going up, but it hasn't, because over the same period, everybody decided China's uninvestable. So over that period, everybody was taking capital out of China rather than putting it in, even though China was gaining productivity by heaps and bounds. So those were the three anomalies coming into the summer. Three, in essence, deeply, deeply unstable equilibrium. And when you've got prices that are way out of whack, it doesn't take a lot for these prices to shift. So what we saw this summer, I think, was, or a few weeks ago, 2 weeks ago, was obviously the yen started to go back towards some semblance of fair value, or at least some semblance of not being just ridiculously undervalued. And we started to see the air come out of the AI bubble. And, everybody points to, the yen carry trade was the trigger for the unwind, but I actually think it started a bit before that. I think it started when Alphabet came out and said, oh yeah, we spent tens of billions on AI and we're not quite sure how we're going to make money out of this. And perhaps we'll never make money out of this. And then all of a sudden everybody's like, wait, hold on, we're not going to make money with this? And what the hell is the point of all of this? And so I think with that, you had a market shift. And so to your question, have we started a bear market? I believe we have, partly because the past bull market that we've had was mostly focused on US tech, mostly focused on AI and all these things. But bear markets are not the end of the world. In our work, we always say there's two kinds of bear markets. You got your garden variety bear market, a 20% drop. And then you got your Ursus Max, your sort of 50% drop that are career ending. 20% drops are healthy. They happen, and they allow capital to shift, themes to evolve, capital to move from what used to be hot to where it's going to go now. Now, what's interesting is I think we've started this bear market, and as things, not an Ursus magnet, it's a sort of 20% drop. And as the dust starts to settle, what do you find today? As you look through the landscape and you look at what is making new all-time highs as we speak? You know, what is the one asset class that is making a new all-time high today? And you might not like this, but what is the one asset class making an all-time high? It's gold, right? Gold is the only asset class today making a new all-time high. And I think that's a very important message right there.
Yeah, it's a fantastic conclusion here. So I guess when we're talking about maybe a garden variety bear market, my question for you is like to go through that a little bit. So how does that feel? What does that look like? Does a recession kind of kick in? It seems like a garden variety bear market, and like some of Bankless listeners, their order of magnitude for what a bear market means. Yeah, you mentioned a 50% down. That would be like a career ender. We call that a regular bear market in crypto. In
Yeah.
fact, that would be like a muted bear market. I mean, like our assets go down 70, 80%, and those are the top tier assets. Like the majority of the long tail go down 95% plus. But anyway, I understand in kind of the equities world and the real world, so called 50% is like real bad. But like 20%, that feels like healthy. It feels like a bear market correction. I guess it also depends though on how long it lasts. So can you go through some more characteristics of this bear market? Does this mean we're in a recession? Does this like take kind of like months to sort of reset and heal with like a new set of assets that take the lead? What else does this look like?
So the point you just made here is fascinating. As you just said, oh, in crypto, 20%, that's just a sort of bad day.
Yeah, we call that a
Yeah,
Monday.
like whatever. Um, and to your point, I think a lot of that is linked to the demographics of the people involved in the asset classes. Like 20% in equities is a bit of a problem. 50% is a huge problem in equities. In crypto, like you said, it's whatever. We see this a few times a year. Um, and and I think it talks to the difference in demographics, right? If you're young and if you're in your 30s, you can take a 50% bear market. If you're really convinced of the asset class and that it's going to come back, it's a good opportunity. You can buy more. The reality today, when you look at the ownership of US equities, it's a lot of people, that are either already or within 5 years of retirement, which isn't the case for Bitcoin or the crypto space. And if you're retired or on your way to retirement, a 50% drop in your equity value is devastating. It's going to absolutely crush your ability to be retired. Which is why, I tend to believe that, US policymakers are now so massively sensitive to changes in asset values. In the US, 70% of people own equities, 70% of people own equities, and pretty much all of that 70% is people who are 45 and older, and who happen to vote. So I'll give you a parallel. In China, over the past 5 years, we've witnessed a 2/3 drop in equity prices and a 1/3 drop in real estate. Now, if this was the case, if you had that type of epic balance sheet recession in the United States, the economy would grind to a halt. It would be one black hole of
Wait a second. Did you say 2/3 of
yeah,
equity
equity prices went
valuation
yeah,
drop over what period
over
of
five
time?
years. Over the past 5 years, equities went down 2/3 in China. Yeah,
Wow.
equities went down 2/3 and real estate prices went down by a third. Imagine if this occurred in the US. Now, in China, this occurred. And today, auto sales are at record highs. Movie sales are at record highs. Restaurant sales are at record highs. Now, I can guarantee you that if real estate prices went down by a third in the US and equity prices went down by 2/3, nobody would be buying new cars and nobody would be going to restaurants.
Armageddon.
It would be absolute mayhem. And this goes to the fact that no economy is as financialized as the US economy. Financial financial markets are now the very heart and soul of the US. And de facto, it means that they can go down 20%, as we discussed. That's a healthy correction, especially if the correction happens to be in things that are expensive, that have already run up a lot in recent years. And, there's a rotation from that part of the market that got to be too big a part too big a percentage of the market towards other things. Sure, why not? And this is what I'm describing. But once you get past that, very quickly, as you saw, equity fell for 3 days, and before you knew it, everybody was on CNBC saying, "Oh, the Fed needs to do emergency rate cuts, and the Fed needs to cut 75 basis points. The Fed needs to cut 100 basis points," because the U.S. really can't withstand a big, it can easily withstand 20%. Don't get me wrong, but it can't withstand much more of a bear market.
Particularly during election
Mm.
years.
It's election year every other year in the U.S.
Mm.
But it's definitely you can't withstand it during the election years. You're absolutely right. But it's, again, you have to look at who owns all these U.S. stocks. It's mostly baby boomers and Gen Xers. And, when are they retiring and how do they own them? And they mostly own them through index funds.
Okay. Well, so then connect some dots for us, right? So doesn't this point to the fact that if bear market, if it even happens, right? If 20% down, we're not going to 50% down because the powers that be just can't let that happen. The political establishment can't, Janet Yellen can't, Jerome Powell can't. None of these cast of characters can actually let that happen. So it can't be any worse than 20% off, because 50% gets us closer towards the Armageddon that we were just talking about. So are you making the case that that's why this will be a shallow type of bear, let's say, and not,
Exactly.
50% plus?
Yeah. Look, you saw it during COVID, right? The asset prices fell. And before you know it, you had monetary policy stimulus and fiscal stimulus, such as the world has simply never seen. The Fed balance sheet blew up from 3 trillion to 9 trillion, or 8.5 trillion. They threw everything they had at it. So yeah, we know. So going back to we live in uncertain times, there's a lot of uncertainties, but this isn't one of them.
Yeah, it almost feels like we live in uncertain timing.
Yes.
But not times. We know what the outcomes are. We just don't know when exactly it's going to happen or what the order of events will be. All right, so let's get to the investment conclusions that I was teasing, because I think these are very valuable and will be sort of a skeleton for the rest of this conversation. So you had 7 of them. And some of this will be just kind of catch up for some Bankless listeners, but I think illustrates the perspective you have on the world in managing your portfolio through these uncertain times. So the first one that I read, and by the way, this was taken from, I think it was a slide that you guys produced, your research company produced. So I don't know if you gave this slide or what, or how familiar these investment points are for you, but for me, they were incredibly valuable to just distill what the conclusions are. So we're going to start with the conclusion and then work our way back for each of these to just figure out how in the heck you came to this conclusion. So the first is this: bond investors will lose money, but policymakers will deflate bond bubbles slowly. I think a way to illustrate this is maybe the slow motion train wreck type of take. And I'll read that again. Bond investors losing money, but policymakers will deflate bond bubbles slowly. Okay. So first of all, what types of bonds are we talking about? Are these long duration bonds? Are we talking, and what geography are we talking about? Is this all countries? Is this the West? Is this primarily the US? What is that bond investors losing money piece?
All great questions. So here we're mostly talking about OECD government bonds. So Western, whether you look at Europe, whether you look at the US, in essence, Canada. So you're looking at Western welfare state government bonds. They're all more or less confronting the same issues, and the losses will accumulate in many ways. But look, in real terms, so far this decade, bonds have already been an absolute disaster. It's in real terms. In nominal terms, it's been a disaster, but in real terms, given that inflation's accelerated a lot already this decade, you're now so far behind. If you held a 10-year U.S. Treasury, a 10-year French bond, or a 10-year JGB or German Bund, that you're just not going to catch up. Yeah, you're not. And that, your scenario for you to catch up, i.e., there's going to be a big deflationary bust, it's growth is going to collapse, etc. That they're going to do exactly what they did during COVID. They're going to go back to fiscal. They're going to go back to monetary policy. the Fed balance sheet will move from 8 trillion to 12 trillion to 15 trillion. So they'll debase their currencies before they allow the economies to deflate. So, which brings me to the second part of your question. This is definitely true of pretty much all Western countries, but it is not true of emerging markets. What's been fascinating so far this decade is the extent to which emerging market bonds, whether Brazil, whether Mexico, whether India, whether China, Indonesia, etc., all your big emerging markets, the big economies, have actually delivered very adequate returns for the bondholders. In all of these countries, the bonds have actually beaten inflation. And to be honest, you had another sign of it in the past few weeks. For most of my career, things like Indonesia, like Brazil, they were the redhead stepchildren of markets, right? So if things go badly, they were the first ones to get beaten up. And here we are, markets all over the place. You mentioned the VIX at 65, etc. And the Brazilian real was up. The renminbi was up. The Indonesian rupiah was up. It's, this didn't used to happen. But it tells you that the world is changing.
Can I ask you a question that I've never been able to figure out here, Louis, when people talk about this, which is, who is holding this dog shit?
Which dog shit?
Like, honestly, this is, as you pointed out, I mean, everyone sees the Fed balance sheet. Everyone knows the playbook, right? A lot of savvy, so who is actually holding long duration bonds in this environment, and why are they doing that? I can never figure out who the sucker at the table is here.
So you have a lot of regulatory buyers, guys who have no choice but to own these things for regulatory reasons. So think of all the insurance companies in the world who have to match liabilities, who by law or by regulations have to match liabilities. So, your car insurance company, and that over the next 5 years, you're going to get, X amount of claims because that's what you calculated. And by law, you have to match those. So you've got all the insurance buyers, huge buyers, all the pension fund buyers, huge buyers. Again, your pension fund, you have a regulatory duty to say, okay, in next year I know I owe X, and the year after I owe X plus 10%, and the year after I owe X plus 20%. And I have to match this with coupons. And so I think so you have those regulatory buyers, but what happened to a lot of these guys is that, for basically a decade after 2008, they had 0% interest rates. And all these guys, if you're running an insurance company, a pension fund, that was a disaster because, how do you match your liabilities with zero interest rates? The answer is you can't. So technically, a lot of these guys were technically bankrupt. I mean, they didn't go through bankruptcy, but if you had stepped in at that time, they would have been technically bankrupt. So when all of a sudden the government say, okay, now you can earn 3%, now you can earn 4%, now you can earn 5%. They're like, after a decade of getting absolutely screwed over, like, oh, this is awesome.
Yeah.
Thank you so much. But it's almost akin to the guy who gets whipped every day 10 times, and now you tell him you're only going to get whipped twice. Like, oh, this is awesome. Only get whipped twice. Happiness, good times. And this is the case of, again, the pension funds, the insurance companies, etc. They were in such dire straits that, if you go through the desert and you're given some fetid water, you're still going to drink it because you're pretty darn thirsty. And that's what these guys were.
I think it's kind of unfortunate because, like, when you go to, like, pension funds, who ultimately owns pension funds, right? I mean, it's workers on the other side of that equation who are getting, subpar pensions into their retirement years, which that's the unfortunate part.
It gets worse than that. I mean, I don't want to depress you, but I was talking about.
Oh, we're well past
depression.
that. Okay,
yes. Well, okay. Let me go. Let's talk through the pension funds, because if you go back to 2008, so 2008, the equity markets collapse, bond yields go to zero, And now imagine you're CIO of a pension fund, and so now you're in a hole because your equities have just collapsed. You know that the S&P over the very long term is going to give you 8-9% at most. And to get out of your hole, you need to make 15%. You need to make 15% a year for the foreseeable future. And so you're scratching your head thinking, I'm not going to get 15% from bonds. They're yielding 0. I'm not going to get 15% from equities because historically they make 8 or 9. Now, wherever there's a need, Wall Street will find a way, and we'll slap on a bunch of fees on it. So what Wall Street does at this time is it comes to all these pension funds and it says, hey, I got the answer for you. It's called private credit. It's called infrastructure funds. It's called real estate funds. It's called private equity funds. All these guys, if you're willing to forego liquidity through the magic of leverage, we can give you 15%. And so all these pension funds do it in spades. Now, what you see as a result is illiquid assets, again, private credit, private equity, real estate, etc., go from what the money managed by those funds goes from $1 trillion to $15 trillion. Now, perhaps you can make 15% on $1 trillion. Can you still make it on $15 trillion? Now, this is where the maths get funky. $15 trillion is more than half of US GDP. So, you look at this and you think, hold on, US GDP nominally is growing by about 5% a year, 3% inflation, 2% growth. US nominal GDP is 5%. And cost of debt is now 5.5, 6. If you're getting a low cost of debt, if you're a private equity guy, it's typically more like 7 or 8. So in an economy that's growing 5, and with a cost of debt of 6 or 7, on an asset base that's more than 50% of US GDP, I'm going to return more than 15%. The maths don't work. It can't work. You have an equity market that's gone from 100% of GDP to 170% of GDP on the hope that it continues delivering 8-9% a year. You have private assets that go from 5% of GDP to about 55% of GDP on the hope that was going to deliver 15%. And then you have, overall debt that's 330% of GDP. That's supposed, if you have government and corporate and et cetera, that's supposed to deliver, let's call it 4.5-5% a year. All this supported by an economy that's growing by 5% a year. Can't work. The maths don't work.
And so, to answer the question of the suckers at the table, it seems like there's some regulatory obligation for some people who are for some corporations, insurance companies, et cetera, to be forced into that position. It's also the pension fund managers who are in really unfortunate circumstance, but that filters down to those that own the pension. And where does that obligation go back to when the pensioners come to the government and they're basically like, hey, this money, these returns I was supposed to get, it's worthless. It just kind of feeds in on itself. I think, I guess on the flip side,
well, eventually be the taxpayer.
Right. I guess on the flip side of this, because a number of people are the suckers at the table, whether they know it or not, unfortunately. I guess the opportunity, or maybe the lifeboat, is if you see this, and this gets to kind of the second point here. Fixed income investors should avoid duration, favor credit, and inflation protection. So if you don't have some sort of regulatory obligation to keep your store value, your wealth, in long duration bonds, and if you're listening to this Bankless episode, unless you're managing an insurance company, you probably don't, and you're probably a bit more active with respect to your portfolio. So you're just not letting some pension CIO kind of manage everything. You have some autonomy over this. You can avoid the iceberg that everyone sees, that we all see coming at us. And a thing that you should do, the implication is into your second conclusion, is just avoid duration fixed income bonds, right? Yep. And make sure that you are doing what is this T-bills are okay because you can get in and out of them quickly, and make sure you're looking at instruments that favor credit and inflation. If you're looking for some fixed income, what are the fixed income sources? Is there anything that's safe here?
when I look at a lot of those Western countries, I gave the numbers for the US, but they're not that dissimilar for France, for the UK, etc. If things don't add up, eventually the variable of adjustment ends up being the currency. So yes, you can be in T-bills, and yes, that's better than being in long-dated bonds, for sure. But fundamentally, what we're describing is at some point a massive repricing of currencies. What's going to happen is as all these unfunded liabilities start to shift onto the balance sheets of the governments, and as people realize there is no way out of this except through massive money printing, a realization that is dawning on people. And so people start to think, okay, to your point, how do I cushion myself against that? Right now, we're in the phase, as we saw with this, people start to think, hold on, this may be a bear market unfolding. What was interesting is, A, you didn't have a rally in the dollar. So, the whole, oh, the dollar is the safe haven, that did not work in the past few weeks. Instead, gold was the safe haven. Everybody fled into gold. And again, gold is the one thing making new all-time highs. And again, an important message there. As odd as it may sound, I think it's actually now safer, and I've argued this for the past 10 years, but it's safer to now be in long-dated Brazilian bonds or long-dated Chinese bonds. Well, and it's not just a valuation argument.
Sure.
It's also, think of where the marginal savings in the world are happening today. Brazil's running record high trade surpluses. China's running record high trade surpluses. And, historically, a lot of these excess savings that China, that Brazil, et cetera, have accumulated tended to be redeployed in US assets, either US treasuries or US equities or US real estate. Now, if increasingly that money just stays at home because the perception is, oh, the dollar's not going down instead of up, then yeah, you'd rather be in Brazilian bonds. Yeah, you'd rather be in Chilean bonds, Mexican bonds, and so on. So I think the opportunity set today, if you're a fixed income manager, the opportunity set today, and again, I haven't even talked about valuations, where the valuations are so much more compelling. You can buy Brazilian inflation index bonds offering you 5.5% real, which is, if you think that equity markets over the very long term tend to offer 4.5%, 5% real, it's like, what else do you need? You get 5.5% real from Brazilian inflation index bonds, unless you think Brazil is going to turn into Venezuela, which there's few reasons to think that. Then, so anyway, all this to say that yes, in the whole scheme of things, I'd much rather own T-bills than bonds, but there are some much better things to own than T-bills.
New projects are coming online to the MANTLE Layer 2 every single week. Why is this happening? Maybe it's because MANTLE has been on the frontier of Layer 2 design architecture since it first started building MANTLE DA, powered by technology from EigenDA. Maybe it's because users are coming onto the MANTLE Layer 2 to capture some of the highest yields available in DeFi, and to automatically receive the points and tokens being accrued by the $3 billion MANTLE treasury in the MANTLE reward station. Maybe it's because the MANTLE team is one of the most helpful teams to build with, giving you grants, liquidity support, and venture partners to help bootstrap your MANTLE application. Maybe it's all of these reasons all put together. So if you're a dev and you want to build on one of the best foundations in crypto, or you're a user looking to claim some ownership on MANTLE's DeFi apps, click the link in the show notes to getting started with MANTLE. Launching a token? Don't let complex legal and tax issues slow you down. TOKU provides specialized support to optimize your launch and ensure that you as a founder and your team and your investors get the most tax-efficient outcomes. The TOKU team understands the crypto space inside and out and will ensure your token launch is fully compliant while maximizing tax efficiency. TOKU can connect you with the best attorneys if you need them to make sure that you have the best advice, and TOKU can help to optimize your taxes so you pay the least possible amount of taxes while still maintaining legal compliance. With TOKU's guidance, you can concentrate on building your company while TOKU handles the logistics. Token launches don't have to be complicated. Talk to TOKU today to get a free initial token valuation. ARBITRUM is the leading Ethereum scaling solution that is home to hundreds of decentralized applications. ARBITRUM's technology allows you to interact with Ethereum at scale with low fees and faster transactions. ARBITRUM has the leading DeFi ecosystem, strong infrastructure options, flourishing NFTs, and is quickly becoming the Web3 gaming hub. Explore the ecosystem at portal.arbitrum.io. Are you looking to permissionlessly launch your your own Arbitrum Orbit chain? Arbitrum Orbit allows anyone to utilize Arbitrum's secure scaling technology to build your own Orbit chain, giving you access to interoperable, customizable permissions with dedicated throughput. Whether you're a developer, an enterprise, or a user, Arbitrum Orbit lets you take your project to new heights. All of these technologies leverage the security and decentralization of Ethereum. Experience Web3 development the way it was always meant to be: secure, fast, cheap, and friction-free. Visit arbitrum.io and get your journey started in one of the largest Ethereum communities.
Let's talk about those much better things. So if number two was basically avoid, anything that has duration with respect to fixed income, like long-term, like Western bonds in particular, then your third investor conclusion is that a balanced portfolio should mainly be hedged against inflation, not recession. And I wrote in some notes here. Basically, the 60-40 plan, 60% equities, 40% bonds, that idea that your financial planner, like at least in the US, that is kind of like accepted logic, that if you want to do well with your 401k or your retirement, it's 60-40. And by the way, that's aggressive, right? 60% equities is a lot. I think what you're saying here, your investment conclusion, is basically that's dead. And it shouldn't be 60-40 equity and bonds. It should be something a bit more like 60-40 equity and gold is your take, or equity and maybe a different assortment of bonds, not Western bonds, maybe some of the Brazilian bonds like you're talking about. So let's talk about this, because this is, if we talked about what not to do, the question is, what should we do? So what is a decent modern portfolio construction to kind of weather the iceberg that we see coming right at us?
I think if you were brought up properly, you were taught pretty early on that there's no such thing as a free lunch. And that is true, of course. There is no such thing as a free lunch, except the one exception to
I knew there was an exception.
Yeah, the one free lunch you get in financial markets is the benefits of diversification. And to your point, for really two generations, since 1981, 60-40 delivered basically the same returns as equity with a third of the volatility.
That was the free lunch.
That was the free lunch. That was, and everybody pigged out on it. It was amazing. It was great.
All you can eat buffet. One of those things that
yes.
only exists in America, I'm sure.
So that was terrific. And it is now over. It's now over because, basically governments overdid it. And when you're issuing an additional 2 trillion of debt every year, you end up killing the golden goose, which is what they've done. Now, the big challenge is indeed, how do you replace that 40% that provided you not only with absolute positive returns, but with uncorrelated returns to equities? Because
to be clear, you need that 40%. You can't just do 100% equities and have the benefits of the free lunch of diversification, right?
I think it depends how old you are. I think the rule of thumb I was always told is you use your age, you go 100 years minus your age, and that's how much you should have in equities. So if you're 40 years old, 100 minus 40, you should have 60 in equities. And if you're 80 years old, 100 minus 80, you should have 20% in equities. And the rest in bonds. That was the sort of old rule of thumb. So all this to say that if you're a young guy, you can be 100% in equities. Now, the big challenge, I think, for any and all investors is that U.S. Treasuries for 40 years, they were in essence the Michael Jordan of assets. They were just absolutely amazing. And
why? Why were they so good?
Why were they so good? Well, first you started off with valuations that were way out of whack, and then you had 30 years of deflation. You had China that emerged on the scene and added 20 million workers into the global capitalist structure every year for 25 years. You had Japan that imploded and that kept exporting capital. You had so many different deflationary forces come at once. You had, in the past 10 years, the U.S. moved from 5 million barrels per day of oil production to 13 million barrels per day of oil production. You had you had Europe massively slash its defense spending because they didn't need to be worried about being invaded by the Soviet Union anymore. So you had like so many different things that essentially, and we were in the demographic sweet spot. You know, we were in the phase where we didn't have a bunch of retired people yet, and we all stopped having kids. You know, we went from having 3 kids to having none. And so we were in the demographic sweet spot where everybody was saving, everybody was consuming, everybody was working. We didn't have to pay for old people. We didn't have to pay for young people. You know, that was great for asset prices. Now that we're getting more and more people retiring, all of a sudden, the maths that worked so well for us demographically for years now work against us. And we thought in the Western world, okay, our demographics are terrible. Our entire welfare system and our entire welfare state is based on us having good demographics. So we're going to solve that by bringing in a bunch of people. In the US, we're going to bring in a bunch of Mexicans and Guatemalans and Hondurans. And in Europe, we're going to bring in North Africans and Turks and whatever else. And as it turns out, unfortunately, you know, the productivity of a worker coming in from Senegal or Algeria in France isn't the same productivity as a French worker. And in fact, the cost of that person turns out to be, you know, quite high. And then there's other issues. Very often they come with their parents. So actually you make the top of the pyramid also pretty heavy. Anyway, leaving all this aside, the welfare states are now failing. And so we are now into a very different zone, one of inflation. Now, in the inflation zone, of course, if we're at structural inflation, bonds no longer do the jobs you want them to do. So you're stuck in the situation of, how do I replace Michael Jordan? Now, the Chicago Bulls are still trying to figure it out, you know, like 40 years later, 30 years later, they're still trying to.
Yeah, there's never been another Michael Jordan. Let's be clear about this.
Chicago's still trying to figure it out. So you could say, oh, I'm going to buy gold. I'm going to buy energy. I'm going to buy Bitcoin. I'm going to buy emerging market debt. And I would say that a combination of all of these is going to be your answer, partly because any one of these is massively volatile and much more volatile than US Treasuries. So any one of these individually is going to add volatility to your portfolio. And any one of these tends to be actually more positively correlated to equity markets than US Treasuries used to be. Now, together, if you say, okay, I'm going to do 10% gold, 10% Bitcoin, 10% in emerging market debt, 10% in energy, together, that volatility is dampened somewhat. But let's not kid ourselves that you build yourself a new Michael Jordan, because you haven't. Because then Michael Jordan doesn't exist. And we could wish that it does. Of course we would. Especially if you're the Chicago Bulls front office. Of course you would. But we have to invest for the world that we live in, not the world that we wish we had. And the world that we live in is now an inflationary world, which inherently means a more volatile world. So we kind of have to accept a higher volatility for our portfolios. You know, the magic days of the 60-40 are gone. We can all bemoan it. It's sad. And then you move on. You bury it and you move on.
Okay, so in this inflationary world, you still want to have sort of some split. And again, I'm just using a 60-40 default, but of course, like your age range, your circumstances may vary. Maybe you're skewed like one percentage or the other, but there's some percentage in this breakdown on the kind of the 60 portion that is like equities. And we'll talk, I think you have some other conclusions on what types of equities to look at in this market. And then the 40% is no longer bonds. Okay, what you're saying, that was Michael Jordan.
No
Michael
longer
Jordan's
Western
gone.
bonds.
He's retired.
Because you can buy emerging market.
Okay, no Western bonds. Okay, so now what we have to do with that 40% is we have to create this Michael Jordan Frankenstein of a basket of assets that might include commodities and energy and gold and yes, even maybe crypto. I think crypto bulls will probably be skewed on that side of things, but that's what the 40% really is. Oh, and maybe emerging market bonds as well. And you have to kind of piecemeal it together, and it's going to be Frankenstein Michael Jordan. It's not going to shoot as well. It's not going to like perform as well as like 90s Michael Jordan did, but that's the best case.
It's going to shoot. I think it's going to shoot better. Actually, it's going to shoot better as bonds.
Better than Michael
Yeah,
Jordan?
it won't defend as well. You know, remember,
we're really going down the
no,
analogy here. I
yeah,
like
because
this.
Michael Jordan was like won a number of years. He won the Defensive Player of the Year. Like that. That's
Yes.
what made him an absolutely outstanding player. He was obviously a great shot, etc. But he was also one of the best defender in the league. You know, this sort of crypto, gold, commodities, emerging market bonds, that will do well for you when things go well. No doubt about it.
Okay.
It'll be when you have to play defense that you'll be like, oh my God, this isn't doing its job.
All right. So basically, get used to volatility with the Frankenstein that you have to build in that section. Okay. So this gets to number 4 investment conclusion. US equities are expensive. Non-US equities are attractively valued, but more cyclical. So basically, the idea is equities in the US are expensive. Non-US is cheap. So now we're talking about the equities portion of that 60-40, and let's dive into that. So why do you think US equities are expensive? I mean, do you have like metrics that you look at? And also, when we say expensive, we sort of mean relative to like what? And I would say probably relative to other non-US equities, right? It's kind of the point that you're making. But like, why do you think they're expensive right now?
I think they're expensive relative to their own history. I think more importantly, they're expensive relative to the long-term earnings power of the U.S. economy. Again, going back to that Buffett indicator of the market cap relative to GDP, it's at extremes today that you've seldom seen. You saw it in 2021, then it came back down, and now you're back up there. But here's perhaps one way to illustrate the expensiveness of U.S. equities. Today, the U.S. is roughly a fifth of global GDP, give or take 20%. If you look at the U.S., it's 70% of the world MSCI. So you buy the world MSCI today, you're getting 70% U.S. Now, for that to make
MSCI, give people
MSCI is basically
who
the
aren't
global.
in these indexes.
It's the global equity index of reference.
Got it.
So most people might think of the S&P 500 as the index of reference for the U.S. The world MSCI is the index of reference for global equities. And
so basically, you're saying is it 70%? Is that what you said? So that's 70% of all equities are U.S. equities, basically. If the value in U.S. equities is U.S.
Yeah. So I think if you look at actually the global market cap, so not looking at the index, if you look at the global market cap, I think the U.S. is like 64% of the global market cap. So let's go with that. So let's go with 64%. Let's go with 2/3. So the U.S. is a fifth of global GDP, 2/3 of the global market cap. Now, if the U.S. is 2/3 of the global market cap, in essence, what do you buy when you buy an equity? You buy a stream of future earnings discounted by an interest rate. Now, essentially, if you're saying, I'm going to buy global equities and 2/3 of it are going to be in the US, you're inherently making the bet that over the next 10, 20, 30 years, 2/3 of global profits will accrue in the US. But the US is 20% of global GDP. Can 20% of global GDP accrue 2/3 of global profitability? Can 4% of global population, which is what the US is, accrue 2/3 of global profits, account for 2/3 of global profits? The answer is unlikely. To me, that seems way out of whack. Just like when Japan in 1989 was 45% of global market cap, and you were looking at it and you thought, hold on, can Japanese companies really accrue 45% of global profits for the next 10, 20, 30 years? So, again, you look at it and you're like, hold on. US painfully grows 5% a year. It's already 2/3 of global market cap. How much more can it grow? Is it going to be 80% of global market cap, 90% of global market cap? Over the next 5 to 10 years, it seems more likely that the trend is the other way.
Okay, can I say 2 things in response to that to give the counter take? And the first is I'll say, what about American dynamism with respect to technology? I mean, we have the Mag 7 in this country, and AI is the next big thing to revolutionize the world in the way that the internet did. So that's one thing I'll say, and park that idea. The second is the US has a fantastic history with respect to its capital markets. and it's, let's call them settlement assurances, a history of, like property rights, let's say. And so, what are you telling us? Like, you're going to go to an emerging country that doesn't have this history and maybe has a history of like revolutions or some political instability. We're going to go to China, and like where government has de facto rights that like certainly they don't have in the US. So I'll say those two things. Basically, there's a premium because America has a property rights system and capital markets second to none. So we just benefit from that premium. And firstly, we also have the Mag 7. We have tech. Like AI is absolutely massive, and don't fade it.
So I'll start off with the second one, because the property rights are indeed super important. And I wish that perhaps we'd have some Iranians or Venezuelans or Russians or Sudanese on this call, because you could tell them all about American property rights and they'd be delighted to hear about them. Because if you were Russian and you owned a property in New York or a property in Miami or some bonds or some US equities, they were just taken from you without trial, without anything, just at the stroke of a pen. And this started really about 10 years ago with Sudan, and then it moved to Venezuela, and then it moved to Iran, and then it moved to Russia. And so increasingly, I think if you're foreign, I think you fall increasingly into one of two categories. You've got the category of foreigners like me who are French, I'm French, who think, yeah, I'm safe in the US, US isn't going to take away my assets because I'm French. But if I'm Chinese, if I'm Saudi, if I'm Qatari, if I start to think, well, if my leaders don't do what the US tells them to do, then do I get all my stuff confiscated? And it's starting to be a doubt in the back of my mind.
So you're saying the property rights are good, but only good if you are a US aligned country and a US aligned
Well, how can you not come to that
citizen?
conclusion with everything that's happened in recent years? And if your property rights are not sacrosanct, if they're dependent on who you are and where you're from, then they're not property rights at all. Let's call a spade a spade. If your property rights depend, I'll say it again, on who you are and where you're from, then they're not property rights.
I think you are 90% of the way to being a full-on crypto bull when you say things like this,
No, no.
because we've got an alternative property rights system I'd love to introduce you
No,
to.
no, no,
It's called
straight
Bitcoin
out
and
of it.
Ethereum and crypto.
Yeah,
Well, let's take that
I'm
aside.
familiar.
How about our tech? How about US dynamism around like big tech and AI, and it's certainly taken the places the world leader there.
Okay. So what is the purpose of tech? What is the purpose of tech? The purpose of tech, I would argue, is to produce better things at a cheaper cost, right? To enhance productivity, to, sure, it's nice to get puppy videos on the internet, and I laugh, and it's nice, etc. But deep down, the purpose of technology is to enhance productivity, produce more at a cheaper cost. So with that in mind, yes, the US has Mag 7 and it's awesome. What goods and service does the US today produce at a cheaper cost than other countries? Because what I
There's
see,
a long silence because I
you're
can't,
scratching your brain.
nothing really comes to mind. You're talking about like physical goods,
Yeah.
right? You're not talking about brands. You're not
No, no,
talking about
okay,
media.
okay, let me
You're not
ask you
talking
this.
about software.
What has US tech done for US cities? I travel in the US all the time. It feels each time I go, New York is worse than the previous time.
Yeah.
What is
This reminds me of the Peter Thiel take of like, where are flying cars? Basically, like productivity has languished, and yeah, tech has innovated and made a whole bunch of people rich from network effects, and the result has been things like Google and social media. But like, these aren't necessarily adding to the two things that tech is supposed to do, which is productivity increases and like quality of life increases.
so? And I was actually, since you bring that up, over the past 10 years, so the US spends 18% of its GDP on healthcare. And for the past 10 years, the life expectancy has been falling. The US is one of the few countries in the world with a falling life expectancy. And I always point to this when people tell me, oh, talk about it, US exceptionalism, we're so far ahead of everybody on tech, et cetera. It's like, well, how come people are dying younger? Like, how can that be? how can the US now have a worse life expectancy than China? Like, isn't this mind blowing? Like 20 years ago, the US was living 20 years longer than China. Now, you look, you go to Shanghai today, you go to Beijing, and I can show you all the ways that tech has revolutionized those cities. From the fake tech on your phone in terms of ordering cabs, in terms of from you know, the trains that are fast, work on time, the traffic that gets regulated, all these things, you do see it. But yeah, you don't have the massive tech billionaires that you have in the US. That's for sure. But you know, the Mag 7s, you could say, well, smartphone is awesome, and it is. And Apple's created a great ecosystem, and it has. And as a result, Apple has gone from trading at 10 times earnings 20 years ago to 35 times earnings today. Do we think Apple goes from 35 times earnings that are, by the way, no longer growing to 70 times earnings? If not, why do I want to own this stock?
I think that's the key point of the investment conclusion here. It's just, you're not saying that basically the US economy is like dead and there's no
No, of
innovation,
course
there's
I'm
no
not.
bright spots here. You're just saying, hey, it's overvalued relative to other things, which brings in the question, okay, what other things? The statement is non-US equities are attractive relative to US equities. So like where?
Well,
Where in the, like,
I'll give you a simple
I don't
example.
do,
I'd much rather
yeah,
I'd much rather own Tencent, which has 15% of its balance sheet, of its market cap in cash on the balance sheet.
so Chinese equities would
Well,
be a place, Chinese tech equities.
I think you have to go look into individual equities, but I look at a company like Tencent, and it's a video game play, it's a fintech play, it's a social media play, and all under one roof, all integrated, and trading at whatever it is, 13 times earnings, 14 times earnings. It's, growing double digit every year. This seems to me like a much better proposition than an Apple trading at 35 times, whose sales haven't grown for the past 4 or 5 years now.
I'll give you that. Let me ask you too, though, if you're looking at these markets as a citizen of France, right?
Yeah.
Are you worried that your property rights in China around buying Tencent or something like this are good if you are a citizen of China, in the same way they're good in the West if you're kind of like under the umbrella of the US capital apparatus. But if you're from France or you're from the US or somewhere in Europe that is that's kind of like, I guess, in this bipolar world, US aligned, maybe your property rights are going to be like not good. So maybe what you're saying works for like someone in China who's listening to this podcast and they're like, okay, yeah, sign me up. I'm already all in the risk here in my jurisdiction. I may as well buy Tencent, but maybe it doesn't work as well for a citizen of the West.
So when did the Chinese government ever seize the assets of a Western citizen? Now, I'm asking, because I can show you plenty of examples of Western governments seizing the assets of Russians, of Iranians, of Venezuelans, etc., because their government didn't do what they were told. But have we seen China do that?
Not yet, no. And I mean, this brings into question of
So are we not projecting ourselves onto China? It's like, we've done it, so we expect them to do it as well.
To be fair, probably in a retaliatory position. It almost doesn't matter who starts doing it first. Do you know what I mean? So if you get into a circumstance where, let's say, China is not the aggressor in this type of capital freeze type of situation, and they're put in this position where they're always responding to, say, like Western aggression to freeze assets, you get into a tit for tat scenario where it almost doesn't matter who the original aggressor was. You could still think of a world where,
if we go down that path, the entire global economy freezes and it becomes a moot point anyway. No. Look. You're talking, the world you're describing is a world where Apple can no longer produce in China, where Tesla can no longer produce in China,
everything's going down in
where
that
Walmart
world.
can no longer produce in China. In this world, you have 150% inflation rate in the United States. In this world, it's, and of course it can happen. China, the US tomorrow can say, I want nothing to do with you. I seize all your assets. I completely lock you out, etc. But let's not kid ourselves that, if this happens, stocks everywhere are down 90%. So at this point, it becomes a moot point anyway.
Can I ask you just like really practically, having not explored this much myself, like, so if you want exposure to non-US equities, what's the best instrument for that sort of
Well, you have
thing? I mean,
lots.
are we looking
I
at,
mean, if you're,
yeah,
again, it depends if you're American, if you're not American, but if you're American, you have lots of ETFs. And I would argue today, things always evolve, but I think, Chinese equities and especially tech equities are very attractively valued. So you could look at an ETF like the KWEB, which is the Chinese tech ETF, trade in the US. But I think Brazil is just crazy cheap today. You look at the two Brazilian behemoths, Vale and Petrobras. Uh, they've both derated. If you're a bit of a commodity bull, which I am, Vale today is basically back on its March 2020 lows, having massively shrunk the share count between now and then. And the share price is pretty much back where it was. Now, of course, you can say, why would I want to buy R&R if a slowdown is coming in the US, if China's on its back, et cetera? But that's where the share price is where it is. Um, the so you could buy EWZ, the Brazilian ETF. I think, to be honest, most of the Latin American markets look terrific. And then the India's having a massive bull market, but it's a super expensive market. Southeast Asia is growing super fast and pretty much uh, forgotten about by foreign investors. But countries like Indonesia, like Malaysia, are growing really, really handsomely. Japan, you've just had a hell of a volatility spike between the yen and the collapse in the markets. I think it's a pretty interesting buying point on Japan. So yeah, lots of opportunities outside of the US.
I love these takes. All right, let's get to number 5. So, equities leadership will rotate from growth to value as global recession fears vanish. And basically, you're saying no recession means like value over growth. What's your take here? So, are you making kind of like two conclusions? Are you saying that global recession fears will vanish, or are you just saying like if they vanish, then we move from growth to value type equity plays?
I think they will vanish. I think people have overplayed the recession fears for the past 2 years. Basically, when the U.S. yield curve inverted 2.5 years ago, everybody started jumping up and down, saying recession, recession. Meanwhile, if you look at countries like Australia, like the UK, they've had inverted yield curves pretty much constantly for the past 3 decades, mostly because of the forced buying of pension funds and insurance companies that we discussed before. Uh, and so if I look at today, my take is to get a recession, most households, most businesses can withstand one punch. And we had a punch. We had the higher interest rate punch. Uh, and, broadly, people have adjusted to it. To get a recession, you need at least a second punch. And historically, the second punch has been higher energy prices. I start off with the premise that economic activity is energy transformed. Now, one of the things we can say is that over the past 18 months, energy prices have been have been immensely well behaved. They basically range traded 75 to 85 bucks on oil, around $2 to $3 on natural gas. Um, Energy prices have not been a constraint for anybody out there. Now, you could tell me this is going to change and oil prices are going to spike, etc. And if they do, then I'll change my mind. For now, energy prices are well constrained, and interest rates, have risen, but not to the point of crushing everybody. And we're now about to start a Fed easing cycle, which is going to lead to a weaker dollar. Now, what I know is that with a weaker dollar, you're going to get stronger growth in Latin America. You're going to get stronger growth across Southeast Asia. You're going to get strong growth in China. I also know that the rally in the yen is terrific news for places like China, like South Korea. And so I highlight all this because, I look at it. If I'm right that the US dollar started to roll over and is now on a weaker path, whatever growth we're going to lose in the US, we're going to make outside in the rest of the world. And for a company like Vale that I was describing, like Petrobras, et cetera, it's really what matters in China. What matters is what happens in China and India and Indonesia and the Middle East. That's what matters for these guys, much more than what matters in the US.
So when it made the statement, equities leadership will rotate from growth to value as the global recession fears vanish. So global recession overplayed, but growth to value.
So
You're talking
if you
about,
look at your
yeah. What
value
does that
stocks,
mean?
yeah, if you look at your value stocks, I mean, you look at your value indices today, it's basically financials, materials, and energy. These are all the stocks that are trading on low price to book values. These are all the stocks that are trading on low price to cash flows. Uh, and they're trading on these valuations because the perception is the recession is going to come, and these guys will have either big asset impairments or big write-offs or big losses. But if you don't have all of, if you don't have asset impairments, if you don't have losses, then all of a sudden you're like, huh, why don't I own this bank at 1 times book? Why don't I own this this energy producer at 5 times cash flow? And so and why do I have to be in Microsoft at 37 times earnings? Uh, Now, if I don't know what the future's like, if I'm very uncertain about growth in the future, then yes, I will pay up for Microsoft at 37 times because I know that Microsoft will deliver come what may. I'm a small business owner. I use Microsoft, and every year Microsoft hikes prices on us by 15%, and every year we pay it because we don't have much of a choice. So it's a terrific business, amazing business, and people pay 37 times earnings for it when they're uncertain about the future. If if they feel there's lots of opportunities elsewhere, then the capital goes there at a much cheaper price.
Whenever someone brings up, like value equities, I just like the name that's inescapable. I think for a lot of people, myself included, is Warren Buffett, and he's sitting on like 300 billion, something close to $300 billion worth of cash right
Yeah.
now. What is this guy waiting for? Is he waiting for that kind of like value rotation?
I know he's perceived to be value, but he's really, he's also perceived to be a quality investor and growth. What is it? Growth at an affordable price and a mode guy. I think what Buffett likes is to own businesses indeed with big moats and high predictability, which is why historically he's not done very much in the commodity space. Why historically he's not done that much in financials. And I know he's spontaneously at the bottom of cycles, or he's made the bottom by doing things with Bank of America, with Goldman, etc. When financials get cheap enough. But um, so what is he waiting for? Well, I think, to be honest, two things. The first is he realizes that valuations in the U.S. are too stretched. What we discussed that 20% of global GDP, 70% of global market cap, so 65% of global market cap. So he realizes this, but he's also not that comfortable in buying abroad because A, he hasn't done it that often. B, it's not it's
It's not his brand,
it's
is
not
it?
his brand. It's like, his brand is I buy American. Yeah, he's done, he's bought a lot in Japan in recent years. So he can and they bought BYD in China, which was a huge home run for them. Uh, So he'll do things spontaneously, but let's face it, he doesn't have the probably the level of comfort doing things abroad or doing things in very large size, because 300 billion is, pretty hefty size, uh, abroad that he does at home, which is understandable. Everybody's got a home bias.
So that gets to kind of the investment conclusion number 6, which is all about home bias, maybe. Global capital will flow from US to Asia and emerging markets in both equities and bonds. I feel like that's been a through line of all of the other investment conclusions that we've talked about. So maybe we don't need to dwell on it. But I guess I'm just kind of wondering what you think is the base case here. Is there going to be effectively the world split up into kind of two blocks, the China aligned type blocks and the US blocks, and then maybe there's this third group of kind of independents, India and such? Like, how do you think the world will kind of bifurcate? Are you a believer in the great decoupling type of idea? And if so, how do you think that happens?
I'm not really a believer in it because for all the talk, I mean, obviously it's been all the talk of politics, et cetera, for the past 5, 6 years. But if you look today, that China exports pretty much just as much as to the US as they did 5 years ago. And then if you include all the Chinese companies that have set up factories in Mexico and Vietnam, Indonesia to sell to the US, then, indirect Chinese exports plus direct Chinese exports are like massively at record highs. The reality is, for all the talk of deglobalization, um, global trade continues to expand and expand rapidly. Having said that, where you're seeing the fastest growth in global trade, it's emerging markets to emerging markets. And this is where all the trade is happening. Now, I think what just happened in August, just a few days ago, was interesting. Is markets, fell apart, and you and I just discussed this. But Asian currencies went up; they didn't go down. Now, granted, you could say, well, it goes linked to the yen, etc. But the renminbi went up. I think this was one of the first time in my career where you had a massive risk-off event, because that's what it was. We had a big risk-off event. You had a big risk-off event and the renminbi rise, which is, something pretty new. And same story for the Korean won, and same story for the Malaysian ringgit and the Indonesian rupiah and so forth. And I think this tells you something important. And it's not so much that Western savings are saying, oh, you know what, maybe I should get myself a little Asian portfolio. This isn't happening for all the reasons you've highlighted, the fear of China, oh my God, they're going to steal my money, et cetera, et cetera. And that's not going to happen. But what is happening is that domestic savings increasingly stay at home. And here, I think you have to start off with the reality that China is running $100 billion a month trade surpluses. That's just gargantuan amounts of money. And that 5 years ago, when really the US started bashing China like crazy, that number was $40 billion a month. So, to put things in perspective, China was running trade surplus of $40 billion a month. The US said, you know what? China's a bad actor. They're like bad hombres. We need to cut these guys off from the global trading system. And over that period, China's trade surplus has gone from $40 billion a month to $100 billion a month. So talk about a complete failure of policy. People in the Western world, in Washington, D.C., should be looking at themselves. The people who came up with the idea of we're going to cut off China from the global trading system should be hanging their heads in shame. Now you could argue, well, if they hadn't done that, it'd be $200 billion. But let's not kid ourselves. $100 billion is the biggest trade surplus any country has ever had in history. It's bigger than Japan's biggest trade surplus, plus Germany's biggest trade surplus ever in history put together. So if that money, instead of being recycled into US treasuries, instead of being recycled into Microsoft and Apple shares, starts to stay at home, that's enough to bid up your currencies, bid up your bonds, bid up your equities.
Yeah, I mean, I think you could also argue for all of that hard talk about kind of like, trade and decoupling. It's just like political posturing, and they didn't really mean it, because the incentives and the game theory is just like not to do that. I mean, global trade kind of like benefits everybody when it works well.
Well,
I guess maybe
on this,
yeah.
I think it's a very important point. You might say, oh, it's political posturing, and they don't mean it, etc., and they don't follow through with anything. All of which is probably right. But now, if you're China on the other side of it, let's imagine you're Xi Jinping and you're hearing all this noise all day, every day. We need to cut China off. We can't give them semiconductors. We can't do this. We can't do that. We need to isolate them. Do you say, they don't mean it? Oh, they don't? No. You have to adjust your policies in accordance to these very hostile declarations coming out of Washington, D.C. Concretely, what does this mean? This means giving preferential trading and tax treatments to countries like Indonesia, to Thailand, to the whole of Africa. It means going in there and offering cheap loans for them to buy your goods. It means trying desperately to crack open new markets. And this is where China's growth has come from. So, we could say, oh, well, we say all these things, but we don't really mean it. It doesn't matter. But on the flip side, China behaves as if it does matter. And when you look at China's growth in trade with Central Asia, with Russia, with Southeast Asia, with Africa, it's all gone absolutely parabolic.
Let's get to the seventh and final investment conclusion, then we'll kind of wrap all of this up. It's just been just fantastic. I've learned a ton. This is about currencies and the value of currencies over time. You said this: the dollar will have to devalue eventually, but mainly against the yen and the renminbi. So the idea that the dollar will devalue, and I wonder what your like timeline is for this type of thing. I mean,
I think it started.
Investors. Yeah. Okay. So like investors have made the case that, the dollar in the short run is a wrecking ball. Others have said, like over the long run, and all of this kind of like inflation of bonds, etc., leads to the U.S. losing its dollar reserve currency status. What do you think about both the short, medium, or the short, medium, and long term of this dollar devaluation?
So I think that so I think it's two separate questions. There's the value of the dollar and there's its use as a global reserve currency. You know,
Oh, you
you,
don't think they're linked? Are they linked at
well,
all in your mind?
let me put it to you this way. You've had plenty of dollar bear markets and the dollar is still being used as a global reserve currency right now. Of course,
Okay.
if the dollar stops getting used as a reserve currency, then its value will absolutely plummet. But the dollar can go down a lot and still be used as a reserve currency. And so for now, I would say that we have started a dollar bear market. Um, and that, this dollar bear market is going to get more pronounced as the Fed starts to ease, as interest rates come down in the US at the short end. A lot of the cash that's just, waiting there starts being recycled into other economies. So, no, look, I think we have started the dollar bear market against the yen. We started against the the renminbi. We've probably started against the euro. It's hard to get excited about the euro because of all the inherent contradiction that come with the currencies and that are, I think, pretty well documented. So it's hard to get super stoked about the euro. Um, but the reality is the dollar is very, very expensive. Explains why this summer there were so many European tourists, so many US tourists in Europe, why there were so many US tourists in Japan. Um, so look, I think we have started to see the dollar roll over. Whether it stays the world's reserve currency has perhaps less to do with valuation as with U.S. policies and U.S. politics.
Well,
And
what do you think about that then? What's the
well, to be
trajectory
honest,
there?
I think for me, I was never much of a believer of, oh, the U.S. is going to lose its reserve status, etc., until the U.S. decided to confiscate all of the Russian assets. And this is not me being a Putin apologist or anything like that, but the way I look at the world is if I look at the U.S., the very reason you mentioned earlier, it's like, oh, we have a great comparative advantage. We have the rule of law. We have property rights. You can be black, white, brown, Asian. You can be
It's credible. It's credibly neutral. It
yeah,
doesn't differentiate who
exactly.
you
You can
are.
be Muslim, Jewish, Christian. You go in front of a court of law in New York, you're going to get the same fair shake as the next guy. Then we add a little asterisk to this and say, except if you're Russian. If you're Russian, you can take all your stuff away. No questions asked. No debate in Congress. No bill in Parliament. Just because the president decided you're Russian, you can take your stuff away. Now, if you're from an emerging market, this feels very familiar. If you're Chinese, you say, oh, if the president decides he wants to take your stuff away, he can. Well, then this is just like, oh, this is what I have back here. Like, this is no different. The president wakes up one morning and decides, oh, because I don't like your president, I take your stuff. And so I was never again a big believer, but I think this broke something. And I think if you live in the Western world, you underestimate the extent to which it broke something because when you live in emerging markets, you live with that fear. You live with that fear of confiscation of your assets because you live typically, and again, I'm not saying this of all emerging countries, but most emerging countries, that's one of the reasons they're not as developed, live in places without independent judicial systems and with limited property rights and limited rule of law. And I think in the past few years in the US, it's been attack on individual rights after attack on individual rights, whether it be the confiscation of the Russian assets, whether it be the vaccine mandates, whether it would be, the crazy COVID confinement laws, whether it be the jailing of the January 6th protesters. It's like thing after thing after thing that make you question, hold on, is the rule of law really a thing here? And what if I just fall afoul of the government? Does that mean I lose everything? And I never used to think the US was that way, but now I don't know. So I hope it gets better. But I would say the past, 5 or 6 years, it's been one worse thing after the other.
So, Louis, this has been fantastic, and maybe just to kind of dovetail to kind of my last question, those have been the 7 for Bankless listeners. I think there's just like a lot of alpha and value just jam packed into this. But since we're talking about financial sanctions and credible neutrality and rule of law and property rights, have you heard about this thing called crypto, Louis? That's kind of what we're all about here,
No,
right? Which is a
believe it or
credibly
not, I have heard
neutral
of it.
money system. Okay, so what's your take on it? Just give me, like, I know you're a gold bull. That 40%, let's say, I mean, your case will vary, Bankless listener, but just some allocation to crypto, to Bitcoin. I get that it's a different investment. You're sort of betting not just on an established kind of store of value. You're sort of taking a speculative bet on a store of value that might emerge, like a future gold. You're taking a bet on just generally the propagation of this, like credibly neutral financial system taking hold. So there's some equity style bets there. But anyway, how do you think about crypto, or do you even think about it?
So I have this debate all the time with my dad, who, in our debates about it, I would position myself perhaps more as a Bitcoin maximalist, for lack of a better word, where I
Oh,
do think I would tend to say that if the ecosystem really, just like you had one currency for the US dollar, it's the sort of to the winner goes the spoils kind of, you know, everything goes to Google and everything goes to Amazon.
power
Uh,
law win.
power law wins. So I would say that now you could say it's not going to be Bitcoin, forget that, it's going to be Ethereum, et cetera. You, like, can have that debate. But I would say if the ecosystem is ever going to be able to really flourish as a parallel financial ecosystem, then the way human condition just revolves, it tends to be to the winner goes the spoils. And right now, it seems to be Bitcoin. For
So you're bullish on crypto, but in particular, bullish
Well,
Bitcoin
no,
relative to
so
other
this
crypto
brings me
assets. Is that
to the
right?
big problem with crypto is
Yes.
um, there's so much junk in the, so many shit coins, so many so much of it will get washed away and the whole side of things. And that's, to be honest, if things are successful, if it does manage to assert itself as a parallel system, then to me, in my mind, it has to be, again, through a Bitcoin maximalist point of view. If it works, it's so I look at a lot of, the shit coins, for lack of a better word. It's if crypto does manage to really, if we really do start transacting in crypto, and if it does become a parallel currency and all these things, and a parallel store of asset, it de facto almost means the death of all those shit coins. And if it doesn't, then what's the point?
What do you think if Bitcoin is successful? What do you think happens to gold?
I think gold does fine. I think that they're two separate things, to be honest. So for me, gold is first and foremost a play on emerging markets. You look at where the physical demand for gold comes from, 2/3 is China and India. And a lot of that is for cultural reasons. So if people in China and India get richer, they buy gold. They buy gold for their daughters' dowries. They buy gold because they don't trust their banking system. They buy gold because they don't trust their governments. And I don't think you shift that anytime soon. That sort of cultural bias. Um, and I would further say that if, like me, you continue to think that wealth is going to keep growing in India and China, then gold will do very well. Uh, so for me, they're basically different drivers. Now, you can say both are driven by the debasement of the dollar, both are driven by, Fed expansion of its balance sheet, et cetera, et cetera. But beyond that, they have very, very different drivers.
So you mentioned that you and your dad have this recurring debate, and like obviously your dad is older than you, right?
Yeah,
And
but he's
you
way
said
more
you're the
into crypto.
Bitcoin maximalist.
Yeah,
Yeah, I was gonna say, is your dad the shit coiner? Is he
yeah,
the one like
absolutely.
buying meme coins on Uniswap
Yeah,
here? What's
absolutely,
going on?
absolutely. But he's always been, in fairness, he's always been about loving the shiny new thing. Uh,
Mm.
He's always been. I remember when we were little. Do you remember those shopper image stores? Oh,
Yeah,
you're
yeah,
probably
yeah.
too young. I don't know if you
No, no,
probably
no, no. I know what you're talking about
the
though.
shopper image stores that had like all sorts of gadgets, like stupid. He could spend hours in there. Uh,
Like a Radio Shack, maybe that kind of thing.
yeah, that
Is that
would.
what we're
Yeah,
talking
but
about?
it was sort of. like robotic dogs and
Yeah.
like
Gadget guy.
it was like just a bunch of gadgets that looked really cool, and you'd buy them and then you would never use them. And anyways, I think they went out of business a while back.
I hope that continues to be an ongoing debate in your family. As you can imagine, it's also an ongoing debate in crypto. We're not done with that particular part of the debate. But hey, it's been awesome to just have this chance to talk to you. I've listened to you on a number of different podcasts, and then I saw some like tweets that really sparked my interest. So I knew I wanted to have you on, and this episode was even better than I knew it would be. So thank you so much, and you're certainly invited back. Can I ask, where do people like find your material, your content, if they want some more hot takes
Sure.
from how you think of the market? What's the best place?
So I'm on X. You can look me up by name. So I post something every now and then there. But the easiest, we have our website, gafcal.com, GAVEKAL. But that's mostly for institutional investors. We own we have a joint venture in the U.S. Private wealth business where we publish also free newsletters. That's called Evergreen GAFCAL. Yeah, you can go to Evergreen GAFCAL for the free newsletter. If you're an institutional investor, go to GAFCAL, or follow me on X.
Everything that Louis just mentioned will be in the show notes for you, Bankless listener. Thank you so much for joining us today. This has been fantastic.
Pleasure.
Gotta let you know, of course, none of this has been financial advice. Crypto is risky, is what I usually say, but so are global markets around the world, including those 50% drops that could be coming in store. You could lose what you put in, but we are headed west. This is the frontier. It's not for everyone, but we're glad you're with us on the Bankless journey. Thanks a lot.